Hi everyone, thanks for clicking and welcome back to my channel. In this video, we are going to learn 10 basic financial terms and their meaning. So without any further ado, let's dive right in. Accounts payable is the money that a business owes to other entities for provided goods or services. This concept represents when a business has received a good or service, often bought on credit, but has not yet paid for it. Businesses display accounts payable as short-term debts or liabilities on balance sheets. A balance sheet is one of the three core financial documents created by businesses. It represents an organization's financial position at a certain point in time by displaying its assets, liabilities, and shareholders' equity. This financial statement lists assets on one side and liabilities and shareholders' equity on the other, and the two sides must equal each other. An asset is an item with economic value that an entity owns and appears on businesses' balance sheets. Current assets, also called liquid assets, represent assets that owners can easily and quickly convert into cash, often within a year. Examples include checking or savings account balances, inventory, and short-term investments. Credit is a contractual agreement in which a lender loans money to a borrower, understanding that the borrower intends to repay it later. A borrower can demonstrate their trustworthiness in numerous ways, such as paying back their credit in full and on time consistently. Credit cards represent the most common example of buying on credit. A FICO score is a three-digit number that measures an individual's trustworthiness to pay back loans or debts. This concept, also called a credit score, demonstrates the individual's creditworthiness. Banks, lenders, and other financial institutions calculate credit scores based on factors such as payment history, length of credit history, and debts. The higher the score, the better an individual's chances of getting favorable terms on a loan or credit card. Net worth is the total value of what an individual or business owns minus the amount owed in debts. As a result, it represents the difference between an entity's assets and liabilities. Individuals can determine net worth by adding up the value of all their assets and subtracting their debt from that total. Accounts receivable is the money that clients or customers owe a business for products or services provided to them. It means that the business has made a sale but has not yet received payment for it. Businesses typically provide invoices to customers that display the amount owed and list accounts receivable as assets on balance sheets. Capital gains are the increase in value of an asset or investment above its initial purchase price. It represents the difference between how much something is currently worth and how much it was worth when purchased. A capital loss, however, occurs when the asset or investment loses value since its purchase. A budget is a financial plan developed by an entity that determines how much money they plan to spend over a particular period. When creating budgets, individuals and businesses often consider factors such as income, assets, and liabilities. A cash flow statement is the third core financial document for businesses. This document reflects the movement of money in and out of a business over a particular period. A cash flow statement measures solvency, meaning an organization's ability to pay its bills and expenses. If more money flows into the business than out of it, the business is cash flow positive. This is it, ladies and gentlemen. I hope you have found this video helpful. If you have any questions or suggestions, please feel free to leave them in the comment section below.